Hey everyone, so in this video we are going to talk about the big bad annuity myths, okay? So if you Google annuity, you're going to see good and bad things. You could Google Jesus Christ, you're going to see good and bad things, right? You could Google anything, you're basically going to see good or bad things. So we are going to debunk some myths, but there are pros and cons to every account, retirement product, to every investment vehicle. There are pros and cons. If there was anything that was considered the perfect investment vehicle, guess what we would all be in? The perfect investment vehicle, right? So you just have to decide which pros and cons are right for you, which pros are right for you and which cons really don't affect you at all. And I'm going to go through the most common annuity myths or the cons, and you could see if they would matter for your client or not. Okay, so let's go. Okay, so again, if you Google it, probably the most common thing that you might read or hear is annuities tie up your money. They lock your money up, all right? And I'm saying it in air quotations because it's kind of true, but not necessarily true in that way. So everything when it comes to accounts, again, there's a pro and a con. So you get a pro, there's probably going to be a con with it. Meaning with annuities, again, the fixed index ones that we do, they're going to offer guarantees, they're going to offer safety, and in exchange, you're basically letting the insurance company know that they can hold on to most of your money most of the time. So what that means is annuities are not necessarily meant for someone who has $300,000 that they've been saving to put towards a house, and they plan on buying that house and putting all $300,000 toward that house next year, right? That time frame is too short for an annuity. So you can access 10%, is probably the most common. There are some annuities that are going to vary, but you can access 10% of your annuity every single year penalty free. So if you have 300,000, then that means you could take out 30,000 a year, every single year without any penalty. First and foremost though, all annuities, every annuity that you go and you write has to pass something called suitability. So life insurance, when you write life insurance, you have to ask underwriting questions that are about their life and their health. So, and if the insurance company doesn't think that they're a fit, they're going to decline it, right? If they pass the underwriting, they pass the lifestyle questions and the health questions, they're going to get approved. Annuities do not have lifestyle and health questions, they have financial questions. And for the most part, the insurance company and you as the agent want to know that when we move this chunk of money from one pocket to another pocket, that the client has access to other money, that the client has access to other sources. If a client only has $15,000 to their name, we are not going to move that $15,000 and put it in a place where they can only take out the 10% penalty free, because the insurance company's not going to take it, right? They don't want to have to deal with people having to take penalties to take their money. This is supposed to be a good thing for your client, not a bad hindrance. So when I talk to my clients, I tell them, I'm going to ask you some financial questions because we want to know that if the hot water heater breaks, the insurance company just wants to know that you have other funds. Like you can call them emergency funds, you can call them other retirement accounts, but they just want to know that you have access to other money. Some annuities that we have accumulate. So maybe you could take out 5%, and if you don't take out the 5%, the following year you could take out 10%. And then if you don't take it out the following year, you could take out 15%. So some of them are going to accumulate to allow you to access more and more of your money if you should want to. But again, when you're talking to your client, like you're going to know if an annuity makes sense for them or not, right? If they have $300,000 in a retirement account, I've asked clients a lot, like, so you have this $300,000 in here. Have you ever had to take out $100,000 or $150,000 all at once? Or can you foresee yourself ever having to do anything like that? And typically their response is, I've had it for 15 years. No, why would I ever need to do that? That's the kind of people that if all the other things line up that an annuity makes sense for, or this 300,000, I have no plans on touching it at all. I want it to go to my kids and my grandkids. So then it makes sense. I mean, technically it's not as liquid. Like, yeah, if you just have it in a TD Ameritrade account or at Bank of America, then yes, you could take out all 300,000 tomorrow, but there's no safety. It could also go down 200,000 tomorrow, right? Because there's no contractual guarantee there. So in exchange for safety and guarantees, then you're just letting them know that they can hold on to most of the money most of the time. So another thing, when you Google annuities, you might see that they have high fees. Typically, that's more true for variable annuities. Again, if you've seen previous videos, then you know that we have annuities with no fees at all. We have annuities with some fees, but the client is opting to pay for it because they have picked a feature that is important to them. Like the income that they're receiving is going to double if they have to go into a nursing home. They want to leave behind as much money as possible, so they're going to pay a fee to have potential for higher growth, like to earn 115% in the market, not just 100%. So most people, if you don't do annuities, like this isn't what you do every day, but they're writing an article about it, or brokers, they might be able to offer annuities, but that's not what they want to do, right? They want the client to have this retirement account where they're paying a maintenance fee or an annual fee every single month or every single year, not an annuity, right? And so they're just going to lump them all together and say, oh, they just all have high fees. You're just paying too much in fees. So again, you could show them that the only reason the account would ever go down is if the client went in and took money out. It will never go down because of fees or because the market went down. The third main thing that you might see when you Google things is it has really low returns. And I would say that that was true, okay? So when you're in the market, you have potential for unlimited gain, but you also have potential for unlimited loss. So fixed index annuities usually were something that would return like 1 or 3%, but guarantee that you wouldn't lose anything. And so that is true, like that they have low returns. That's true in history. So now if you run illustrations, you look at historical data based on the indexes and the participation rates now, then your client can earn between like 6 and 9%. They could earn more than that. Obviously, past performance is not an indicator of future success. That's true for mutual funds and with annuities. But essentially the whole like low returns thing, you can show any client practically any illustration and they can see that that's not the case anymore. It really is similar to comparing your new smartphone, whether your iPhone or Droid, to a BlackBerry or a flip phone. Yes, they are all phones, but they perform very differently than the BlackBerry or the flip phone. Is that kind of sad? I'm comparing a BlackBerry to a flip phone, but they're different. They're still phones, but historically it may have been true, but not true anymore. So the last thing is kind of going to get an honorable mention. It's probably going to be the most uncommon. Like you probably won't run into this, but if you ever hear about it, they will say that annuities are bad because of something called annuitization. So annuitization is when, let's say you had $300,000 in an account and you decided to annuitize. That basically meant that you were going to get income from that $300,000, but because you annuitized, you give up complete control of that $300,000. I know it sounds crazy, right? But this is what happened. And so they would start giving you income from this $300,000 that you annuitized. But if you died at any point, the insurance company actually got to keep the balance. I know. Lifetime income works very differently now. You have $300,000, you start to pull out an income. If you die while there's still a balance, your family gets the balance, not the insurance company, okay? So people think that that sounds absurd, and how did anyone ever agree to do that? But you guys do understand that that's how pensions work, right? Like if a teacher puts in $50, $100, the 8% is a government worker of your pay goes into a pension, like the government pension, right? Or a teacher's pension. And you could receive the money for a year or 5 years, and you die, that pension stops. There is no lump sum that goes to your family. Now, there is something called survivorship, but I would say most people aren't going to pick that because you have to take a cut in your pension. And that we can go into further detail in a different video. But pensions work like that. You get the money while you're living, but as soon as you die, that's it. There's no lump sum. So once in a while, you will hear someone bring up annuitization. It's not very common, but now you know what it is. So those were our debunking annuity myths and just talking about different pros and cons and how things can be negative, but if it literally doesn't affect you because you never foresee yourself taking a lump sum, you don't need to pay any of the fees because you don't need any of those benefits. They do have returns. There's no annuitization. Then the cons don't really affect you because it literally doesn't affect you. So I hope this video was helpful and we will see you in another one. Thank you so much. You are very loud upstairs. I don't know if I can hear you. I don't know if the video is picking up.
Probably.
So you get to do something about it.